In our previous video, we discussed on input GST. In this video, we will discuss on the output GST. Think of output GST as your temporary job as a government agent. You collect taxes from your customers, but don't worry, you are not keeping it forever. By the end of this video, you will handle output GST journal entries like a pro. Let's dive into the world of output GST with our favorite entrepreneur, the pizza shop. When the Peter of that pizza shop owner, he doesn't just charge for the food, he also collects GST from you, isn't it? From their customers. So, this is output GST. The GST you collect when you sell goods or services. We call it as output GST. But here is the key difference from input GST. Output GST is not your money. You are like a middleman collecting rent for your landlord, isn't it? So the government is the landlord here. So GST is the rent. So think of it this way. If the Peter charges 100 rupees for pizza plus 18% GST, the 100 rupees is his money, his income, whereas 18 rupees is belonging to the government. Peter is just the delivery boy of that particular government money. So the golden rule of output GST is the output GST is a liability. It is the money you owe to the government. So that's why we credit output GST accounts, because it represents our obligation to pay the government. Let us master the output GST journal entries. Remember, output GST gets the VIP liability treatment, isn't it? So the basic sale with output GST. Let us take an example that Peter sells pizzas worth 5,000 rupees with 18% GST extra. How this journal entry we have to pass? Let us see. So pizza sales is 5,000 rupees. GST is 18%, 900 rupees. Isn't it? So the total collection is 5,900 rupees. So the journal entry will be cash account debit. So enter 5,900 you are getting, and to sales account 5,000 rupees, to output GST account 900 rupees. So understand these three concepts here. So cash account gets the total amount received, that is 5,900. Sales accounts gets only the actual sale value, that is 5,000. Whereas that balance 900 rupees goes to the output GST account because it is the liability. So why do we credit sales and why do we credit output GST? Because sales represents earnings, credit, and obligations are the liabilities, have to be credited. So this is one scenario. Another scenario, if the customer is rejecting your pizza because of the quality issues. So when the customer is returning back 1,000 rupees worth of pizza plus GST, the journal entry will be the sales return account debit 1,000 rupees, output GST account 180 rupees, to cash account 1,180. Here output GST will be debited because earlier we had credited, right? The liability we had considered. In this case, when the customer is rejecting, we are actually getting back the goods which we have sold earlier. So basically we are reversing the sales, and the liability also we have to reverse. So earlier output GST we credited, now we have to debit. So when the goods are returned, we reverse the output GST too. It is like giving back the tax collection responsibility along with the refund. So students generally do these kind of mistakes by including the output GST in the sales value. You please go through the question very carefully as to whether the sales value is including tax or excluding tax. Never inflate your sales with GST. Keep them pure, separate like oil and water. So what are the pro tips for output GST success is that always separate GST from its sale value. And remember, you have to credit output GST because it's the money you owe to the government. And remember, different rates, different accounts. So always we have to split whatever input GST and output GST we debited and credit accordingly, right? We have to split up as to input CGST and input SGST. Accordingly, output CGST and output SGST we have to segregate. And always remember, we have to reverse the entries for whenever we are purchase returns or sales return and cancellations are happening. So please remember this. We have to reverse the entries. So here is a quick snapshot what we discussed so far. When we sell goods, we have to collect GST, we credit output GST, and we owe it to the government. We have to pay it back to the government, right? So when we collect it from the customers. So think of GST output as temporary pocket money. You hold it for a while, but it is not yours to keep. So we have to give it back to the government. Whereas input GST and output GST are perfectly opposites. So input GST is like an asset we have to debit where money is coming back to me. Whereas output GST is a liability, we have to credit it because money going from me to the government. So now students, you have mastered both the sides of the GST coin. Input GST, what you pay and can recover, and output GST, what you collect and must pay forward. So together they create a beautiful GST ecosystem that keeps our economy running smoothly. In our upcoming videos, we will be discussing the specific problems relating to the GST. Until then, please keep watching and keep revising and keep learning. Thank you.